Bank of America that has a big high-price newsletter. I think it's north of $10,000 a year for institutional traders. And also the chief investment officer of Morgan Stanley have been in the news lately, where Morgan Stanley says no longer 60-40, 60 stock, 40 bonds. It's 60-20-20. Sell half your bonds, buy gold. And Michael Hartnett says, no, it should be 25-25-25-25, stocks, bonds, short-term treasury, and gold. And so here you have two very large commercial banks. And by the way, Morgan Stanley has been a huge seller of gold leading up to this. And all of a sudden they come in and buy over 600,000 ounces, where you have these big banks who never talked about gold at all, any allocation, now saying as much as 25%.
The recent volatility in gold and silver isn't random. It's a calculated orchestration within the paper markets. As prices are forced down during thin overnight trading sessions, major institutions quietly step in to accumulate physical metal. Evidence points to deliberate actions to temporarily suppress prices, allowing the most prominent players to secure real assets at discounted rates. These tactics reveal not just market manipulation, but the strategic unwinding of a system built entirely on paper, promises, and debt. AndySchectman, CEO of Miles Franklin PreciousMetals, explains that behind the scenes, massive institutions like Bank of America and Morgan Stanley, once dismissive of gold, are now publicly allocating up to 25% of their portfolios to it. Simultaneously, deliveries on the COMEX have surged, with record-breaking amounts of physical metal being taken off exchange. This is not regular market activity. It's an early sign of transition from synthetic to tangible wealth. As fiscal instability worsens and government credibility continues to erode, gold is reasserting itself as the ultimate hedge against systemic failure. The reallocation of capital by major banks signals that the paper era is ending and sound money is returning to the center stage. Now we present the clips from AndySchectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Central banks, foreign governments will continue to buy gold and silver now, unless there is a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government. And I think there'll be volatility. Look, this is a game where, largely because a lot of things that we've been talking about since 2020, when I started talking to you about the deliveries that we saw, those were the beginning signs of a system that is all about paper promises, rehypothecated paper promises coming unraveled, where countries and sovereign wealth funds and very plugged in individuals and groups realize that it is indeed the Achilles heel of the entire system, and they would rather, I think, slowly exploit the metal and the commodities out of the system before there is a mad dash for them. And you know, a lot of people in this country, instant gratification isn't fast enough, and we've seen that with the rise and proliferation of cryptocurrencies and stocks like NVIDIA and Apple that have defied gravity. One would say, well, why don't they just come in and buy it all up? And because you would see the strains that we're seeing right now in the LBMA, you would have seen them blow up instantly. And so this is something that is not only coordinated, but also methodical, very well thought out, and done so little by little. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the COMEX. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the COMEX is irrelevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on COMEX will do so on the first day notice. But what we have been seeing is deliveries like in gold that are 93% higher later for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the commitment of traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery and an immediate contract in October. So what was interesting to me about it as well was some of the, I think it's Michael Lynch, I think is his name. I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with COMEX, and he talked about the footprints that he saw, that the two entities that, first of all, on, I want to say Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts, all at once into a very thinly traded illiquid market, period. No one would ever do that. They did. And it's done for effect, specifically for effect, to drive down the price, to guarantee the absolute worst settlement, the way that it should have been done. And when the mainstream talks about this, they neglect to tell you, well, by the way, it was all dumped in the middle of the night or, after New York trading. That would change the outcome. I think it invalidates the valid reasons. It was done for effect, not the way that it should have been done over hours or days, bled through New York where there's great liquidity to ensure the best settlement. Anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1 and gold about halfway up, because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional. And if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett and for the lead analyst for Bank of America that has a big high-price newsletter. I think it's north of $10,000 a year for institutional traders, and also the chief investment officer of Morgan Stanley have been in the news lately, where Morgan Stanley says no longer 60-40, 60 stock, 40 bonds, it's 60-20-20, sell half your bonds, buy gold. And Michael Hartnett says, no, it should be 25-25-25-25, stocks, bonds, short-term treasury, and gold. And so here you have two very large commercial banks. And by the way, Morgan Stanley has been a huge seller of gold leading up to this, and all of a sudden they come in and buy over 600,000 ounces. Where you have these big banks who never talked about gold at all, any allocation, now saying as much as 25%. This was done for effect, and it was done either to cover shorts, to take possession of physical, or to rattle the bushes and make people think all of the things that the mainstream said, a lot of which were valid. Gone up 9 straight weeks in a row, was overbought, in need of some sort of a flush. Okay, I believe all of that. And if it had been done properly, short, the right way, over time, instead of all at once, when the market was liquid instead of when it was illiquid, well, maybe I'd believe that. But it was done for effect. And so I would suspect after I research tonight or tomorrow morning what happened today, we'll see similar footprints in the snow that will talk about this exact same thing.
The recent collapse in gold and silver prices wasn't the result of normal market dynamics. It was a carefully staged maneuver. The paper markets were deliberately hit in thin trading hours to manufacture panic and flush out weak hands. Meanwhile, behind the scenes, physical deliveries on the COMEX are exploding, with nearly 38 million ounces of silver moving this month alone, one of the largest in history. While the public sees a price decline, major financial players are taking advantage, covering short positions and standing for immediate delivery. This is not a market in retreat. It's a transfer of real wealth from paper to physical hands. At the same time, the U.S. has added a staggering $1 trillion in new debt in just 71 days, pushing total debt toward 130% of GDP, a level historically reserved for nations in crisis. Global trust in the dollar system is eroding fast. China's cross-border interbank payment system, CIPS, now spanning over 185 countries, allows trade in yuan that can be instantly converted into gold through the Shanghai Gold Exchange. This yuan-to-gold backdoor signals a shifting world order, one where gold, not debt, is regaining monetary power. The illusion of control in Western markets is cracking. Gold is quietly being remonetized on a global scale. Let's get back to the interview.
How this pull down was engineered and what kind of buying there was on the other side. At this point, I'll say, no, I think we've covered it, but we're always here if we have to jump on. I'm always here if we have to jump on if something big happens. If not, we'll talk all about it next Monday. I'm sure there'll be lots to talk about, not only about this current correction, but also maybe anything else that has happened up to that point. Nowadays, things are happening at such a breakneck speed that I'm sure we won't be at a loss for things to talk about. The U.S. government added $1 trillion to the debt in 71 days last month. 71 days from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done as far as I am concerned. But yeah, this is a deal where the shipments out of both the COMEX in New York or the shipments into COMEX in New York or out of, some of it stayed in there, will be roughly 38 million ounces this month of silver. And, that will put it on pace to be one of the biggest delivery months ever. This is a deal where, at the same time, you have one of the largest short positions ever on SLV. Over 80 million shares are naked short to affect this. There's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. And SLV has an 84 million ounce short position or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So I guess it's shares. So the shares are being driven down, which affects the price. But yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But, when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the COMEX. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And, again, think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't. And if you're holding treasuries and you see the fiscal irresponsibility mounting, at some point, this debt does become a problem. And the people who point to it not being a problem, I think, are missing the picture. China building its own financial plumbing to get around the U.S. dollar system because it's no longer trusted. And, we focused a lot on Enbridge, but the CIPS system, the cross-border interbank payment system, which is China's version of SWIFT, SWIFT is, in my opinion, the rails to what the Enbridge system will be. It's over 185 countries already are using SIPs to settle, including the Asian countries, which we've talked about before, which are 35% of global GDP right now, and China's biggest trading partner, twice the population of the United States. But the kicker is that once countries accept payment in yuan, like Russia sells oil or Brazil sells soybeans, they don't have to just sit on stacks of Chinese yuan. Through the Shanghai Gold Exchange, those yuan balances are actually convertible into gold. And this means that exporters who don't want to hold yuan can take that money and they've earned and go right to the Shanghai Exchange and convert it into gold bars. It's effectively a yuan to gold backdoor. And the next vault, as we talked about, is being built in Saudi Arabia. And this is why you'll hear analysts talk about this petro-yuan to gold trade. Instead of taking dollars for any commodity, the yuan is now convertible into gold. It's not backed by gold, but it is immediately convertible into gold. In essence, the system is finding an alternative to the dollar-based system, which since 1971 has only been backed by trust and confidence. And you can see that's slipping on many levels. And so I do think that this is the underlying reality that isn't getting better, nor is our fiscal responsibility. We are at 123% debt to GDP. Most of my career, any country at 100% would be considered a banana republic. And in just 71 days, we at 100 billion a week. How long can that go on? I think, people need to think about this. And maybe this is why you're seeing big money start to move into gold. The central banks have been front running it. And now you see Bank of America, Jefferies, Morgan Stanley, JP Morgan. They're all saying they're reassessing their outlook on gold all the way up to 25%. And when you see Michael, the big bond trader, the bond king for BlackRock, that Jeffrey Gundlach, say a 25% allocation to gold is not overweight. That's just unheard of to say that. Look, the deliveries off of COMEX to me, really more than anything, are telling you that the most sophisticated traders in the West feel the same way. And if they're going to knock the paper price down, well, they'll cover their shorts and they'll stand for delivery. And we're seeing that. It's an emotional thing to see price fall the way that it did, but it is really done in a very irrational way that isn't being reported. And they're dumping it in a matter specifically to affect that type of sentiment and that type of aggravation.
The financial system is reaching a point of no return. Each move in the paper markets, every artificial slam in gold and silver, is a desperate attempt to preserve confidence in a dollar that's rapidly losing credibility. Behind the scenes, the most prominent institutions on Wall Street, once dismissive of precious metals, are now quietly pivoting. Major banks are openly advising clients to reallocate up to 25% of portfolios into gold, signaling an explicit acknowledgement that the old 60-40 model is finished. What was once a hedge is fast becoming a necessity. The truth is, this isn't about short-term trading or speculation anymore. It's about survival in a system overloaded with debt, leverage, and denial. With U.S. debt spiraling past $38 trillion and interest costs eclipsing every other budget line, the foundation is cracking. Meanwhile, the rest of the world is already preparing for life after the dollar, constructing trade routes and payment systems backed not by promises, but by tangible assets, by gold. The global reset isn't coming, it's happening quietly, as the world reorients toward tangible value. Prepare wisely, stay alert, and never underestimate what's unfolding before our eyes. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video.